Well, if you have been anywhere near a newsfeed lately, then you know that so far 2026 has been a difficult year for the stock market. I mean, it has been all over the place. But how has that impacted you or your family? Because rising oil and food costs aren't just data points on a graph. They have real-world impacts on your gas tank, on the food that you put on the table for you and your family. But we believe that we are called to good stewardship when it comes to our money and our investments. And that means being prepared and not panicked. And that's our topic for today on the Current Temp. Hi, everybody. Thank you for joining us. Again, I want to say thank you right out of the gates to the fantastic men and women of Lexus of Memphis. What a great product. What a great people. And you are looking at individuals right here that drive them and love them. We're big fans. We're also big fans of this guy, Mr. Bill Gurner. You know him, you love him. He's a senior portfolio manager. I work alongside him every day. And we've got some great questions for you today. Bill, thank you for being here.
Happy to be here.
What we're going to start with is the economy. And Bill, it's something you and I look at every day with the team that we are lucky enough to work with. So let's start with this. Let's start with geopolitical, because it's going to impact everything. We've got a war going on, and that's really affected not just oil prices, but the entire market.
You know, I really hate talking about politics, but in the market, it's being affected by this war. And it's just amazing because gas prices have gone up as you go to the pump and you see, but oil is so important to everything we do, and I don't know that if you know, I don't know. Oil is used in so many products.
Yeah.
I mean, we just don't know. So when people deliver food, the cost of delivering that food goes up. Everything goes up. But I think the economy is doing okay. I think I know that the third quarter of 2025. The GDP and you know, that's the output of goods and services, and the higher the number, the better. And so it was around 4.7. Yet in the fourth quarter last year, we saw it drop down to 0.7. So it's really been volatile, and we're waiting for the first quarter of this year to see how it's doing. But we did see the ADP put out jobs report, and we saw where we had around 63,000 new jobs. And the good thing is, to your politics, they weren't government jobs. They were private sector jobs.
Right.
So I think with all that's going on, I think when they build these factories for AI and all the movement that's going on, I think the economy is going to be okay.
Well, that's a great snapshot, and that's kind of one of the things I wanted to talk about. The economy is still positive, even though there's a lot of negativity in the press. Consumer spending is held up. The labor market, as you said, still relatively strong. We've seen some slowing in hiring, some upticks in unemployment. But this is not a recession. Would you agree?
I agree. It's not a recession because we still are seeing unemployment rate around 4.3 in that range. And you know, another interesting thing, Joey, we've seen the mortgage rates from a year ago around April of 25. I think the 30-year was around 6.6. And now today it's 6.4. They haven't fallen like we would like to help these younger people get into houses.
Right.
And the 15-year has dropped too. So we see rates easing down, but it would help if they would come down. That would stimulate this economy quickly.
Perfect time to talk about inflation. Inflation has come down from the peak levels, but of course not fully solved yet. Core inflation, wages, services, still a little sticky. Goods prices are easing, but services still remains a little elevated. Shelter costs, you just talked about housing, that's still lagging. We're probably not going back to ultra low inflation anytime soon. So how do you think that impacts investors?
Well, if we look at 2021 through 2023, we see where inflation was extremely high. We see it coming down toward the Fed's target, which is very positive. And I think there's a chance if a few things fall in place that we will get a cut. And I think the economy is going to do well going forward. I may be the only one in the room since just you and I, but I do think
I agree.
I think it's going to do well.
I think we're going to see a post-war rally. But again, we don't want to get too caught up in forecasting right now. Let's jump into interest rates. You know, the Fed's trying to balance things. We talked about inflation. We've got Jerome Powell on the way out. That's going to have an impact. They don't want to cut too early because of inflation risk. They don't want to stay too tight. They don't want to slow the economy down. What are your thoughts on where we are with the interest rates?
I'm going to come at you from a different direction from your opening comment about politics, but I do think this to some degree. I think with the housing, with these young people not being able to get in houses as easily as they would like with the interest rates this high, I think the two parties are kind of jabbing each other, and I think one party wants to head more towards socialism where they can control the housing like in New York, and the other party wants to lower the interest rates where the people can have their own houses and they own their own equity. But I do think we'll get there to lower rates, and I just don't know how long it's going to take. But like you said, Jerome Powell leaves, I think, the end of May, and we'll have a new chairman. And I think there's a chance that we could see 2 or 3 rate cuts this year, which would really stimulate this economy.
Well, you and I are about to do a little education here. We're going to talk about growth and value stocks. As we start seeing overvaluations, and that's a case where as we're looking at the bottom line of companies, they look a little overpriced. Maybe they're a little expensive for what their earnings are. And so there's been a lot of talk about growth versus value. So I thought we would do a quick breakdown on growth versus value here. Two primary types of stocks. Growth stocks are companies that are expected to grow quickly, and they usually reinvest their profits back into the business. Value stocks are companies that may appear undervalued, like they're a really good buy. They're usually stable or well established and typically pay dividends. We talk to a lot of our clients who want to know about these two companies, and in particular, dividends, right? People don't seem to understand dividends. You want to try to explain that?
Well, dividends are like if you own an apartment, the value of those apartments may go up and down during the economic cycle. But the thing that you do want from those apartments is for the renters to pay the rent. So you get paid a cash flow while you wait for the appreciation on that apartment. So the market's no different. If we're down right now, and to your point, I think, and it's not unusual because if you look at the first quarter of 2025, we were down like 5.6%. And the first quarter of this year, we're only down 4.33. So the world's not coming to an end. And this is a good time to put your feet in the water and buy some stocks. But value stocks are kind of like the rent I was mentioning. You get paid a dividend usually on those stocks. And so you're getting paid while you wait for that market to come back.
Yeah, I think that's a great thing for us to sort of underline. A lot of people don't understand. These are two different types of stocks or equities. So when you're talking about stocks and bonds, when you buy stocks, you can buy growth stocks or value stocks. And we look at both at our firm. And the value stocks often will pay you a dividend, as Bill just said. So to continue this sort of educational part, and I know I've gotten a lot of comments from you folks, you love this. When you're talking about investing, and you're talking about stocks and bonds, those were stocks. This is an example of a bond. It's called fixed income. You may have heard that term, fixed income. And what fixed income is, it's an investment where you're basically lending your money to a government or company, and in return, they're going to pay you regular interest payments. And then at the end of the term, you get your original investment back. And an example are treasury bonds, corporate bonds. You've had decades of experience in this. Kind of want to reiterate how bonds work alongside stocks?
Well, bonds pay a dividend. You get paid twice a year. And then you can buy the bond at par, below par, or above par. But to me, you can get a yield equivalent or better than bonds in stocks. And the difference is this. I said we did a segment on compounding. When you get paid a dividend from a stock, you get paid 4 times a year. Mm-hmm. You get the same rate you get on a bond, where you're compounding, and over time you would do extremely well. And a lot of returns from stocks are from dividends. So dividends are important. And it depends on where you are in your life. Right. If you're a 20-year-old, you don't care about dividends. You want to go into take some risks, go into some growth stocks. Value stocks, they run in cycles, and I think you're right, Joey. I think value is in favor now.
Well, and to Bill's point, to kind of underscore it, it is important to remember everybody's different. Every investor is different. What your profile is will have an impact on what you do, whether it's stock heavy or bond heavy. And so we take that into account.
Yeah. And, the other thing I looked at today, and I hope I remember this right, but I think we've seen this is haven't seen this before. There's been withdrawals in the bond market for the last 68 months. We've never seen anything like it. So I don't know what people are doing, but they're coming out of bonds. So and I think stocks are where you should be, but people get worried about the volatility of the ups and downs. But if you don't look at it and let it work for you, you'll come out better, because I think stocks are the best investment vehicle there is out there, better than private equity, art, gold, whatever you want to talk about.
I've seen you prove that with a lot of clients. And again, friends, a lot of this has to do with when you get into the market. Last 3 years have been gangbusters, and stocks have done really well. Right now, they're floundering. But to your point, and what we've seen play out over decades, is that when you can commit over a time frame to the market, it's a pretty efficient vehicle.
Yeah, and you just made me think of something, Joey. You know, half of the growth in the U.S. economy, I think last year, was from AI centers, the data you get from AI, and that's continuing to grow.
That's not going away.
And, you know, this first quarter, the stocks are down, but I think the large tech companies will be the first to bounce back, as we've seen.
Yeah. Let's build on that. Let's talk about the current risks at this moment, because we've had a lot of folks that have wanted to talk about, okay, what's going on with the market? I see that there seems to be up and down, and everybody's talking about it. And by the way, don't buy into a negative press cycle. We know that the press is constantly finding things to dramatize, glamorize, and sometimes amplify, and that can lead to movements in the stock market. But I just noted a few things here. We started with the geopolitical uncertainty. That's a war in Iran, that kind of thing. We've got inflation we're dealing with, interest rates, tariff policies. All of these things impact the daily movement of the market. And if your president just happens to post something on a social media tomorrow, it goes bananas one way or the other.
Yeah, but you have to think long term. I wrote these numbers down. Let me read them to you. The first quarter of this year, the stock market, the S&P 500 was down 4.33. But if you look at that from 1 year, it's up 17.8%. You look at it for 3 years, it's up 18.32. 5 years, 12.06. And for 10 years, 14.16. So that compounding and those tight double-digit returns, you increase your wealth pretty quickly.
Well, and I think listening to those numbers and knowing what we both know, it's a great time to remind people it's not a great idea to jump in and out of the market and trying to time it, because you might say, okay, I'm going to get out and because things are a little wobbly, but then you miss the 1,000-point days like we've seen yesterday where it goes up like crazy.
Well, you're reminding me of a quote from a 6th century poet. He said, "Those who have knowledge don't predict, and those who predict don't have knowledge." So I try not to predict, and that's why I was mentioning the long term.
Yeah.
You need to be patient, let it work for you, because companies that are making money, they will continue to do so. And this war will end. And I think the president's speaking tonight, and I think it may be positive. If it is, the market will pop in the morning. So we'll see what happens.
Well, let's give everybody something to think about. I wanted to finish and close down with what should investors be focusing on or thinking about. So I've got a couple of points here. Don't chase what's already run. You know, we see a lot of investors who want to jump into something usually when it's at its peak, and that's usually the worst time to get in. Diversification, something to focus on when things are a little unstable. Focusing on fundamentals. That's something that I know our team does every day, and we had a meeting today to talk about those things. And if you're going to use bonds strategically, any of those points are something you would add?
Well, I think there is a time for bonds. I mean, I'm not saying you should cut them totally out, but I think that you need to be careful and not go long term, because a lot of people don't know this. If you own a 30-year bond, you have more risk than you have if you were in the stock market. So I would say if you are going into bonds, stay 1 to 5 years, stay short.
And one of the key things as we draw this to a close is learning your profile. And that's one of the things we really do and strive to do at our firm is learn who the investor is. Do they have an appetite where they can handle some volatility, or are they wired to where everything makes them nervous? That plays a big role as well, meeting the customer where they are.
That's exactly right. And that has to do with age and their risk tolerance. So that is important, very important.
Any closing thoughts?
Oh, I have many. How long do we have?
She's getting nervous.
No, I think everybody needs a plan, and I think a lot of people think, well, I'm not going to live to be 60. I'm going to spend it all now. And I think you need to really have a plan and follow that plan. And I think you need to have income coming in where you can compound. And I don't think and the other thing I think people think, they think that professionals can time the market, that
Right.
they can hit these peaks and valleys.
Right.
You can't do that. There's nobody in the world I've ever seen that can do that, because if you can do that, I can prove to you, you have to be right 70% of the time to outperform buy and hold. And it's just not possible.
No, and you're not going to roll the dice like that. I think that's an excellent way to sort of wrap this up and encourage people, especially if you're getting close to retirement. Find an advisor, find somebody to talk to, because we do a lot more than counseling on investments. We talk about tax implications and how Medicare and Social Security are going to work together. Those are things that you need to know. And we're also about to witness one of the largest transitions of wealth in history as baby boomers are retiring and passing on and going to glory. Their descendants are about to get a huge amount of money. So I think being wise and good stewards, which is how we open this, being good stewards, is kind of critical. And I'll let you finish with this. I know I have sat with you in church teaching sessions about being good stewards of our money. I think that sort of underpins the way we think about it.
I think the example in the Bible was the 5 talents. Don't you think that's a good one? Because
yeah, I do.
The man was going off, and he gave one guy 5 talents, 1 3, and 1 1. And the guy with 5 talents doubled the money. The one with 3 did okay, but the third one didn't do anything. He buried it in the backyard. And a lot of people think about that, but they think because when you travel back then, you had a good chance of not making it back. And I don't know if this is true, so he buried it. If he didn't come back, then he would have that talent. But I think you have to invest wisely. You have to be patient. You have to take a long-term outlook, and things will work out for you.
Yeah. Hey, friends, if you need help, we're willing to help put our talents to work for you. All right. That's a good way to close it. Let's end with this. The Current Temp is accepting applications to be a sponsor. And we've heard from some of you. We've had some great conversations. So if that's something you might be interested in doing, you want to reach a very smart and engaged audience, because that's what you are, just email us at thecurrenttemp@gmail.com. There it is right there. We check those emails. If you got an idea for a future show, or if you know someone who might be a good guest, we've heard from some of you on those as well, giving us some ideas that have turned out to be some really fun shows. We'd love to hear from you. Bill Gurner, thank you for being here.
Thank you.
We had a good time. And friends, have a great week.